Hey everybody, Mortgage Seth here with my weekly news update newsletter. Thanks for watching the video. If you're not subscribed to the newsletter, let me know, send me an email or hit me up on social media, Instagram, Twitter, Facebook. It's all Mortgage Seth right here. And I'll add you to the list. So for this week, we got housing data and the Fed meeting last week, which was made for a jam-packed week of news for the markets to digest. Sales of existing homes fell from 2% in July and August, reaching an annual pace of 5.88 million units. Much needed inventory also ticked lower, unfortunately, falling from 1.5% in July and August to a 13% year over year decline in available inventory. So that's putting a lot of pressure on the market. But sales of new homes beat expectations. They rose 1.5% from July to August. And there were also positive revisions to July's data, which means the gain is really like a 4.5 rise month over month. So we are seeing some new home sales helping out with the inventory, but the overall inventory is definitely down. Builder confidence held steady in September per the National Association of Home Builders Housing Market Index. This real-time read on builder confidence came in above expectations, rising 1 point to 76. The drop in lumber prices, stabilization of other prices contributed to the increase in confidence. Yet ongoing supply chain issues and labor shortages are expected to persist. Housing starts, which measures the start of construction on homes, rose 4% in August. While this is positive on the surface, looking closer at the data shows that starts for single-family homes, which are in such high demand, fell nearly 3%. Building permits, which are a good forward-looking indicator of construction, those increased by 6% in August, while single-family permits inched higher only by 0.6%. So there's new construction going on, but some of it's starting to shift to multifamily construction happening, and that's the inventory we're seeing come out, which is more geared toward investors. CoreLogic released their second quarter equity report showing that equities increased almost 30% from last year. Negative equity homes decreased by 12% from the first and second quarter, 30% year over year. This equates to only 2.3% of all mortgage properties have negative equity. So there are people out there with more equity than ever before, thanks to the home price appreciation. So great opportunities to refinance, tap out that equity to use for other investment purposes, or make those home repairs that you've been putting off. Employment news. Initial and continuing jobless claims moved in the wrong direction in the last week. They ticked higher to 351,000, 2.8 million respectively. But the big story was in the decline in pandemic unemployment assistance, which we all expected as Labor Day passed, and the pandemic emergency claims. Those all fell by 752,000. And last, the Fed held their two-day meeting of the Federal Open Market Committee, and the key takeaways I'm going to talk about in a second, but this was a big Fed meeting to talk about what was going on and what they may be talking about doing with interest rates coming into the near future. So the tight inventory hindered August existing home sales. That measures closings on existing homes. That fell 2% from July to August and reached an annual pace of 5.88 million units. Sales were 15% lower when compared to August of last year. Sales of single-family homes were also down 2% on a monthly basis, but they're only 3% below the same time last year. Note the annual comparisons are tough based on the dynamic of the pandemic last year, so sometimes these year-over-year numbers are a little skewed. Much needed inventory also ticked 1.5% lower in August, now to 1.29 million homes for sale nationwide, and inventory is down 13% year over year. So again, putting a lot of pressure on prices and the appreciation of prices that we're definitely seeing in our markets. The median home price, which was reported at $356,700, this is up 15% of August last year, but it's really cooler than the 18% annual increase reported for July and 24% increase from June. So just keep in mind that the median home price is not the same as appreciation. Simply means that half the homes sold were above and half were below it. So it's kind of an indicator of where the homes are selling, but it's not necessarily an indication of the appreciation, and that gets confused a lot. So that's median home price, which is showing what people are buying. First-time home buyers accounted for 29% of sales, a notch lower than the 30% seen in July, and cash buyers remain stable at 22%, but this figure is still up big from 16% last August. Investors purchased 15% of homes, which was stable from the previous month. What do all these figures suggest? Well, investors may be crowding out first-time home buyers. We're seeing that in a lot of markets. They're purchasing the lower priced homes that they can rent out. because of the big rent appreciation that's also happening. So a lot of the pressure on the market right now is coming from investors coming in and buying up these lower priced homes to just turn around and rent them out. And there's some controversy about that in different markets. I know in my local area, there's some talk about the benefits of that, or if it's something that needs to be looked at. New home sales beat expectations last week. The report came out. It measures the signed contracts on new homes, came in stronger than expected, rising 1.5% from July to August. And there were also positive revisions to July's data, which means the gain is really like 4.5% rise month over month. New home sales are at 740,000 annualized, which is down year over year by about 24%, but off tough comparisons from last year because of the pandemic. Looking at inventory levels, there were 378,000 new homes for sale at the end of August. This is up 1.5% from July, but it's down 24% when we look at year over year, because we all know what happened last year with new construction and the price of lumber and all the other factors. The median home price was reported at $391,000, which is 20% higher year over year. Again, this means that half of the homes that sold were above this level and half below. Not the same as appreciation, but builder confidence is definitely inching up higher. The National Association of Home Builders Housing Market Index, that's a real-time read on builder confidence. It came in above expectations, rising 1 point to 76 in September. Looking at the components of the index, current sales conditions rose 1 point to 82. Sales expectations for the next 6 months were unchanged at 81, but buyer traffic rose 2 points to 61. And we're definitely seeing that with the amount of people on the wait list and the demand for new houses that's stacking up as people are returning to look for new homes. Any reading over 50 in this index, which runs from 0 to 100, signals expansion. The drop in lumber prices, stabilization of other prices contributed to the increase in confidence. However, delivery times for new homes still remain extended due to the ongoing supply chain issues. Labor shortages are also expected to persist, so that's affecting the build-out schedules of these new construction homes. They're having trouble getting appliances, materials, and labor is also affecting those schedules. D.R. Horton, who's America's largest home builder, said that it expects homes closed for the fourth quarter of fiscal 2021 to be in the range of 21,300 to 21,700 compared to the previous range of 23,000 to 24,500 due to the significant disruptions in the supply chain, including shortages in delivery, like I mentioned before. So they're expecting to complete 10% less homes than previously forecast. So not only is there tight inventory in the resale market and high demand, there's also a lot less inventory coming on in the new construction, which is affecting the pressure on upward prices and the appreciation there. Single family home starts declined. That measures the start of construction on homes. It rose 4% in August with an annualized pace of 1.6 million homes. This is 17.4% higher than August of last year, but housing starts for single family homes, which is the most crucial, that fell 3% at a 1.1 million pace. So building permits, they're a good forward-looking indicator of construction. That rose 6% in August, 13.5% year over year. Single family permits did tick higher, but only by 0.6%. Housing completions, which speak to delivery times being delayed, were down 4.5% in August, though completions in single family homes rose nearly 3%. However, the number of single family house permits, but not even started yet, is up 50% from last year. So what's all this data really telling us? It's telling us that overall housing starts were higher in August, but starts for single family homes fell, and single family permits were essentially flat. Builders are having a difficult time completing homes, which shows the supply issues we're facing are going to continue. With demand rising and remaining strong, all these factors point to the likelihood that homes will continue to appreciate for the foreseeable future. There was a big decline in COVID plan jobless claims. The number of people filing for unemployment the first time rose by 16,000 in the last week. Initial jobless claims were reported at 351,000. Continuing claims, which measure people who continue to receive regular benefits, also increased by 131,000 to 2.85 million, bouncing off pandemic era lows. These figures moved in the wrong direction. The big story is that the COVID enacted plan saw significant improvements. Pandemic unemployment assistance claims, which provide benefits to people who would usually not qualify, and pandemic emergency claims, which extend benefits after regular benefits expire, fell by a combined 752,000. As of the latest reporting, 11 million people are still receiving benefits throughout all programs, which is down 856,000 from the previous report. Is a November taper announcement ahead? Well, that's the rumor. At last week's Fed meeting, it was especially significant because they've been under a lot of pressure to reduce their monthly purchases of Treasury. Been purchasing $80 billion a month and mortgage-backed securities of $40 billion a month that were enacted to keep rates low and aid the recovery. The Fed has said that they want to wait before tapering or reducing their purchases until inflation reaches their goal of 2%, and there's substantial further progress towards maximum employment. They want to, that's their charge, is to keep the employment as high as possible and reduce that unemployment rate. They previously said that their target for inflation, which is currently reported between 4.2% and 5.3%, depending on if you're looking at personal consumption expenditures or the CPI, has clearly already been met. So they're signaling that they may take some action. They didn't make an announcement regarding tapering at last week's meeting, saying their monetary policy statement. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. And that's a quote from the meeting notes. So they're starting to signal that tapering may happen here. And once the Fed begins tapering, they're expected to reduce their purchases by $15 billion per month. This would mean that if they begin tapering in December, they'd be done with their purchases by the end of June. But in that time period, they would still buy an additional $660 billion in bonds, which is $60 billion more than they bought during the QE2 program that they used to help get us out of the 2007 and 2008 recession. So in other words, the Fed policy should remain very accommodative for a very long period of time. Regarding inflation, the Fed affirmed their continued stance that much of the increase we've seen is transitory due to temporary bottlenecks in supply chains. The Fed has been increasing their inflation expectation throughout the year, but they expect inflation to drop to 2.2%. Some of the increases in inflation may be due to these transitory factors. We've also seen wage pressure inflation, which tends to be stickier. In addition, there's anecdotal evidence from companies that supply chain issues may not be cleared up by the end of next year, especially when it comes to shipping costs. All right, the last area to cover is the technical picture and what to look for this week. So more housing news follows this week, starting with an update on home price appreciation on this week via the Case-Shiller Home Price Index and the Federal Housing Finance Agency House Price Index. So those will come out later this week. Pending home sales for August will also be reported later this week. Also note, durable good orders for August will be reported. And this week we have more final estimates on the second quarter GDP. So lots of figures coming out this week that could move the markets and will give us some technical indicators of what's going on. Important inflation news comes at the end of the week with the Fed's favorite measure, personal consumption expenditures. That'll be reported for August along with the personal income and spending. So after testing the support of the 100.133 Fibonacci level, if you like to look at charts and see what the technical indicators are, you can take a look at what mortgage-backed securities are doing. The mortgage bonds, they were able to bounce back off this Fibonacci resistance level. So they bounced back higher and ended last week trading in the middle of a wide range. The 10-year is broken above its 100-day moving average and is now trading about 1.45%. There's room for yields to continue higher, which means that mortgage-backed security prices will be dropping, and that'll have a negative impact on rates. So we're going to start to see rates creeping up even before this tapering is starting to happen. And I'll keep you informed on what's going on. And if you have any questions or anything that I can help you with, you can find me on social media, or you can send me an email, text, whatever's best for you. It's mortgageseth.com everywhere. And I hope you have a great day. And if you liked this, leave a comment below. Let me know what you liked, what you didn't like, and what you'd like to see more of next time. Thanks so much.